The stock market has been super volatile this year and is down so far. What should you do about it? That's what we're talking about on today's episode of Friends Talk Financial Planning. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Marmel. I've got a fee-only financial planning practice in Chicago, Illinois. Before we talk about the stock market gyrations, please subscribe. It helps YouTube viewers find us. Okay, John. So what are you telling clients about the stock market tanking?
Yeah. I know it's interesting that we're getting a lot of not calls, but having a lot of conversations about it. I suspect you are too, right? It's on people's mind. It's interesting for me that we get about half the people are saying, "Hey, things are on sale. How do we buy more?" Right? And other people, and the other half are going, "Hey, where can I find more mattresses to hide all my cash and kind of bury my head?" Right? So it's this yin and yang thing. And of course, when things are on sale, we want to buy them, right? That part of it is appealing. One of the things that I often go back to when it comes to the investment part of financial planning is just sort of looking at facts and looking at history and what's gone on. And one of the things, we'll put a link in the show notes to the JP Morgan Guide to the Markets, but one of the things I refer to often is a graphic that talks about historically going back to 1980. So we've got almost 45 years of data, and the stock market is up on average 3 out of 4 years. But during the year, the market is down at sometime between January and December. It goes down an average of about 14%. And so what that means is, you think about that, right? The market is up most of the time. Like if you're going to make a bet, if I'm going to flip a coin and somehow that 75% of the time it lands on heads, and you go, listen, we'll bet $1 every time we flip a coin. You go, how many times can we flip that coin, right? That over time that's a winning proposition. But then we also take a look at, that inner year decline where the market goes down on average about 15%, 14%. And you go, we haven't had that in 2 or 3 years. And so when the markets is down, and at last I had taken a look, it was down, 3 or 4% on the year. And it kind of feels like, oh my gosh, what's going on in Washington, and what's going on in Ukraine, and what's going on in interest rates and tax law and all these stories. And then for me, it's a matter of stepping back a little bit and going, oh, you know what? On average, we see this happen just about every year, and we haven't had one in a couple of years. So maybe this year we'll be down a little bit more at some point during the year. And it's sort of normalizing it, right? And recognizing that this is something that happens. It's not necessarily it's not different this time. I think is really helpful to think about.
Right. And in my office, Luke talks about how valuations are still high. So, the stock market, maybe there's internal reasons why, the stock market's high, right? And so, they call them corrections, and it's okay. The stock market goes up and down. That's what we actually expect from it. And it's been a nice run. So, it goes up and down. The other thing I think is that when people, they say on the news the stock market's down, and then they talk about that for however many sentences, and then they probably don't talk about, but maybe say, oh yeah, and international's up. Okay. But when we look at, so what I'm talking about with people when I'm looking at their portfolios is like when they're talking about it, they're looking at these two lines, like the large cap and large cap value. Like that's the part of your portfolio that they're talking about. And they're not mentioning, or maybe they mention in one sentence, that these parts are going up. Right. And so that overall, and they have no clue that US actually half of your money is in safe stuff. It's not even in the stock market. And so the pundits don't know that. They don't mention that. So it's like the amount of reaction people feel like I'm going to lose all my money, and the actual reality are, the reality is usually much reduced from what people's fear is.
Right. Yeah, no, I just had a conversation here. Let's see if we can maybe even pull it up. Is the exact same thing you were talking about, where somebody was talking about, oh, the stocks are down. And I said, well, yeah, but we don't have just US large cap stocks. S&P is certainly down. So I found information from a place called First Trust, puts out some good data. And what's the date on this? March through March 15th. So what is that? 10 weeks into the year? The S&P 500 was down about 4%, but international stocks were actually up almost 9.5%. Right? You don't hear about it. I'm going to start using that when people say, boy, the market's down. I go, really? I thought it was
Oh,
up, and
right.
because we don't think about it. You just brought up it's all, and there's a reason, right? S&P 500 is, I don't know, something like 70 or 80% of the world uh, uh, uh,
I think it's
economy, or
less.
of the
I think it's less.
market.
Yeah, but
Like,
people
it drives
definitely,
a lot of things,
yeah, right.
right? So it's not like it's wrong to look at that, but that's not the entire story. And I know if we don't, your clients, we don't have all of our money in those places, right?
No,
And
yeah,
so you take a look at having that diversification. And I will tell you, last year, right, when the S&P was up 25%, and our clients have international stocks and those things were up like 4%, you're looking at that going, man, that was a stinker, right? You go, yeah, but the trade-off is now S&P is down and those things are up. That's why we have this diversification, right? And so
right,
just looking at some of the facts sometimes can be really helpful in thinking like, oh, stocks are down. Well, some stocks certainly are down, not all stocks.
right.
And I,
And
I
thinking
really,
about, yeah, right. And thinking, going back to the basics, like you were saying about your diversification, but another thing is how much risk are you really taking? So when we look at portfolios, there's 10 different items that we look at to figure out how much risk people should take. Okay. And one of those is, how do you feel about it?
yeah,
Okay. So if somebody's saying I should sell things, I'm like, well, are you saving less? No, I'm still saving 12% of my income. Okay. Do you have any more dependents? No, I don't have any more. Actually, one of mine, there's now not even as dependent. Like, do you have your own business? Are you taking more risks in other places besides? It's like, no, I just sold my rental property. Like, cause that's, again, like, so when we look at it, how you feel about it is one factor, but there's other factors that are equally important.
yeah,
And but reevaluating. The other thing is, as you retire, as you get going from I'm working and bringing in some money to I'm totally retired, generally people feel more conservative, and a portfolio should be more conservative. But that doesn't mean no stocks, because usually if you're let's say you're 70, well, maybe you might live another 30 years, right? And so the stock market should go up in those 30 years. Like, so I feel
right,
safe in saying that the stock market will probably go up in those 30 years, and you will probably want some of your money, not all of it, in stock market. And you want to have some safe so that you have 10 or 15 years of spending that's just there. It's not even on the table in the stock market. So I just want people to take a bigger picture, a larger picture, and say, oh, I gotta strap in and hang on for this.
right, right. I love that idea that you brought up about it's not just about investment risk, it's about life risk. Like
Right,
what risks are you taking overall?
right,
Right? And the same, it's not just what happens in the US large cap stocks. It's, do you run your own business? Well, that's riskier and would lead to a more conservative, investment portfolio.
right,
Do you have guaranteed, or you're retired and on a pension that's secure and social security? You go, well, maybe you can take more risk in the stock.
right,
It's life. It's not just this pocket of investment dollars. It's all my dollars and all my financial planning that goes into it. And it's easy to lose track of that over time.
right.
Yeah.
Absolutely. And I think that people underestimate this cash flow positive. If you've got a pension or if you've got social security, well, that money's coming in,
Yeah.
and so that actually lowers your risk. Like, that's low risk.
Yeah,
So
that's right. The other
anyway,
thing you brought up that I just wanted to circle back on is that idea of, most people aren't all in stocks. And certainly
right,
if they were, they wouldn't be all in US stocks. And we just had a conversation recently, and, this idea like, hey, it's kind of scary when you read the news, but if you have half your money in bonds and cash, right? And you know, and
Right.
half your money in stocks. Well, you're only taking, you know, only half that money is subject to what's going on in the market.
Right.
And if the market things are divided into international and US, only a fraction of your money really is in that S&P 500. And I go back to that idea of thinking of investments as a farmer or a gardener, right? You get your crops out in the field or out in your garden. That's where you make money, but that's also where you take risk, right? Because you might have a flood or a drought. And when you have good years out in the garden, you can some of that and you put it in your pantry. And that's where those bonds come in and the cash comes in, right? In your pantry, you know, your pickles don't grow very much in your pantry, but they also don't go away. They're there when you need them. And having that you just said it is having that, oh, wait a minute, no, only half my money's even in the market in the first place, and most of that's not in US large cap stocks. Again, just looking at those facts can be really helpful.
Right. And so you're saying back out in the fields, you don't have everything in one crop. Like,
Right.
so, you know, you got at least a couple of crops, you know, you're
That's
not all,
exactly it.
and you got some, maybe some cows and some chickens, etc. So, yeah, it's not all in one thing. All of your eggs are not in one basket for most of our viewers. And if they are all in one basket, then, and this is a wake-up call for you, then it might be a good time to evaluate and say, okay, maybe I should spread it out. But then don't, next time international's down, say, oh, time to go back to the US. You know,
Right.
that's not the approach. It's like just slow and steady, well diversified. And the research is that that's what pays off the best.
That's right. That's right. That's a great place to wrap things up here. Again, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
I'm Bridget Sullivan Mamel. I've got a fee-only financial planning practice in Chicago, Illinois. John and I are both proud members of the Alliance of Comprehensive Planners. We're both taking clients, but if you're looking for an advisor that's in your area, you could check out acplanners.org.
And don't forget, hit that subscribe button.